Hi, everybody. Well, my name is Maxim Kon. I'm one of the board members of the Crypto Valley Association. I hope you can hear me well. Not well? All right. Good. In my normal professional life, I'm a compliance and risk manager and consultant. But here we have today experts from different fields of industry. You have already met Tim Rice, the CEO of Coinmetrics. We have also Anoosh I will not say, sorry, Anoosh. She is the Chief Risk Officer of Zodia, a custodian. We have Laurent Henderickx from AON, an insurance company, and you are the digital assets practice leader of there. And we have Josh Peschko, who is the head of compliance at Talos, a trading infrastructure provider. So we have different companies from the crypto industry, and Tim gave us already a great head start, but more from a macro perspective in terms of risk. Now we will take a look from a micro company level risk management approach at the world of risk and risk management. We call it the Risk Management 360 panel. We will talk about risk today from different perspectives, starting with identifying the risks and trying to mitigate the risks as much as we can and figure out what risk is there that we have to live with, talk about insurance in detail, and we'll be excited about the outlook. May I ask you guys to introduce you in more detail? Tim, maybe you can do a little bit more deep dive into what Coinmetrics does and yourself as a person.
Sure, thank you. So as I mentioned, I've spent 4 decades building data businesses for large regulated financial institutions primarily. Coinmetrics was founded in 2018. We're a crypto data and analytics company. We cover both the on-chain and the market data space as well as the index category. Our clients and investors are large financial institutions such as Fidelity, Goldman Sachs, Bank of New York, Chicago Board of Options Exchange. And that's where we do most of our business activity, is with that large tier client and large hedge funds, as well as we do a fair amount of work in the Oracle space across Chainlink, Redstone, Pyth, and other areas providing content to there. So we've been at it for 5 years, seen a lot of different things, as I said earlier, but it's really a pleasure to be here.
Thank you, Tim. Anoosh, would you quickly introduce?
It's a pleasure to be here. And I mean, just even looking at this auditorium, thinking about how far crypto has come, that we're here talking about risk, and there's so many people. So thank you for coming to this. I'm Anoosh. I've spent about a decade in traditional finance, so working for Citigroup in a number of roles, all of which were in the payments sector. So it's really quite interesting to now shift over about 4 or 5 years ago over to Zodia Custody, which is a digital asset custodian. We've had the head start in the sense of we're a venture underneath Standard Chartered Ventures. Having that background has allowed us to go through some painful experiences over the past 3 or 4 years, which have now put us in a stead where we're ready for regulation. We're ready for things like MiCA. It's really not a heavy lift for us. We're ready for further establishment, formalization of various different requirements. So yeah, I'm really excited to talk about risk today and everything that we're doing and some of the challenges that we're seeing and maybe some of the emerging things that we can also do to work together to make the industry as a whole more mature, as Tim was mentioning.
Thank you. Laurent?
Yeah, thank you also for having me on the panel. Just a small comment. We're not an insurance company, we're a broker. So basically what do we do at Aon is we help the client to secure and to obtain coverage through the traditional insurance sector. We've been in this space since 2013 by being the first who offered crime insurance to large custodian and exchanges. And we also have an innovation pole in the UK and the US.
Thank you. And Josh?
Hi, working? All right. Josh Peschko, I'm the head of compliance strategy at Talos. Before Talos, I've been there for about 2 years. I was at AQR Capital Management for 16 years, which feels like a lifetime. AQR is a very large quantitative hedge fund known primarily for their kind of model-driven alternative investments, which is an interesting conversation. I think I've been hearing more and more crypto and digital assets being described as an alternative investment, so we'll talk a little bit about what that means. Prior to AQR, I was at JP Morgan in the risk department.
Thank you. Well, you and I were closer to the compliance world, and I think the typical risk that a compliance person would say is AML risk. Would you give us a little introduction into the risks that you see in your company other than AML risk, but maybe also touch up on that?
Yeah, absolutely. So if you're not familiar with Talos, Talos is a software provider. It powers many of your infrastructures. So basically, if you are an institutional player in this space, buying and selling crypto, portfolio manager, OTC broker, custodian, whatever it may be, we connect all those pipes for you so you don't have to hire a humongous engineering team. So at AQR, where many of the people came from that came to Talos, or founders from AQR, we had 60 engineers supporting kind of the full stack that Talos can provide. So it saves you a bit of money. When I came into crypto and to Talos, it was almost right before FTX. So it was a very good learning experience for me to see how some of the differences are about how the risk is approached when you are doing business with somebody. So your partners are extremely important in this industry, as we all know. It's super collaborative. We get a lot done, and it's a very happy, friendly workplace. I think something that I noticed immediately is kind of, maybe an optimistic way to say it's too trusting, but there's no concept of a conflict of interest that you want to dig into, or even asking the question. So the relationship with FTX and Alameda was really one of the larger pieces of this whole thing, and that's a conflict I think in traditional finance that would be escalated and talked about more, and oftentimes maybe not would be avoided completely. So I think more and more as you see these operational due diligence teams coming in and they treat digital assets like an alternative investment, you're going to see a much deeper dive into conflicts of interest. And conflicts of interest are okay. We all have conflicts of interest, right? Like we might have brothers that work in competing companies, but disclosing those and then knowing how to handle those and risk mitigate those is really where we're kind of losing that message. So that's the one thing I think I would say right away I noticed. The other thing I think, and we'll see this as our industry evolves, is just the concept of a more mature counterparty risk management. So I think when people start, it takes a lot of time and a lot of legal fees and lawyers to negotiate all these agreements with all these different counterparties. In traditional finance shops, you have teams of people that do that, and that's what they do. And it's not fun, but it creates an environment where you have multiple counterparties. You're not relying on just one. So, when FTX goes down or somebody else goes down, you can quickly switch over. And especially as we get into the area where these asset managers are managing other people's money, so it's pension funds. There's a heightened level of responsibility to continue to be able to trade and to continue to be able to risk manage. And an excuse saying, "Oh, my counterparty is down," it just won't fly. So those are the two things I would note: is the conflicts of interest and then kind of the counterparty risks.
Thank you. Anoosh, you as a chief risk officer, but from a slightly different product field, would you have something to add?
Yeah, absolutely. So I think of custody as the plumbing to the digital asset ecosystem. It is dependable, it is quiet, it is boring, but it is super important at the end of the day. As a custodian, obviously our biggest risks are looking at the safety of the client's private keys and how that's managed and making sure that any transactions are verified, authenticated, and they're appropriate as needed depending on that client. Now, as you think of that, I think one of our biggest investments has been how we actually safekeep the private keys and how we protect that and the measures we go through to ensure that the instruction is coming from the client itself. And what I've seen in the industry is that many companies look at that in a really, really manual way. It relies on humans to make decisions. And if you think about the volume of the assets that are actually under custody and how much of that is prone to human interaction, it's prone to video callbacks. You're seeing fraudsters take a really novel approach with things like deep fakes, etc. I think one of the things that many custodians are looking at is really maturing themselves, trying to understand how can they automate processes. I think at the end of the day, you need to think about how quickly the crypto ecosystem in its whole is actually also, it really has attracted a lot of institutional interest, and that's great. But sometimes people negate the fact that we're also looking at small teams that have gone really big. At the end of the day, sometimes those teams are sub 100 people. And I'm not taking a dig at that at all, but we need to understand as well where you have concentration risk. So very much tagging on to what Josh was mentioning earlier, when you're thinking about that counterparty risk, just think of it in its broadest sense. Don't just look at it in terms of, oh, exchanges and how much credit exposure do I have, but at the same time, just think about where you have those concentrations. If you're staking, think about the validator nodes, who's staking those. Are those all centralized in a specific geography, in a specific cloud service provider, et cetera? Like, I feel like that's something, that's the hidden risk that is there. It's staring us right in the face, but we don't talk about it enough.
Thank you. Tim, well, not talking about letting all burn. How do you, like, within your company and within your client field, what risks would you also add that are like a bit more micro that have not been mentioned yet that you see as very important?
Yeah, I'll just double down on the counterparty risk. I mean, one of the beautiful parts of this technology, open public blockchains, is the disclosure of addresses. And so, kind of piling on what Josh was saying, you know, one of the reasons people have kind of plowed through is some younger teams have been afraid to ask for disclosures. Like, you don't need that. It's like if you look at the FTX situation, when I go to get a banking license anywhere in the world, they probably know what I had for breakfast because they asked for that much in order to engage with fiat money. In the crypto space, like, we now have the ability to ask for those disclosures from affiliated entities with something like FTX. And they should have had to disclose Alameda, and they should have disclosed the addresses of those two firms, and you would have been able to, in real time, see the intermingling and the efforts that were going in between them. So I think there's a lot of work being done on private blockchains. I'm a maxi on public blockchains and the transparency that they offer and the security they provide, so I think that's super important. I think we spent a lot of time several years ago, and still, you know, we were kind of ahead of things and looking at what is the risk that could occur on a blockchain. So I kind of highlighted, is it a 51% attack? Is my transaction in the next block going to be included? Is there an MEV activity going on where I'm going to get excluded? Is the chain up and operating? And if you look at some of the disclosures, risk disclosures in the, at least in the US, in the filing for all of the ETFs, you will see a list of risk disclosures related to on-chain behaviors. All of those can be monitored and resolved. I think we're just quick to get there. So we focus a lot on the on-chain side. What's going on with nodes? Are they up and operating? Is there a 51% attack mounting in the stablecoin environment? For every stablecoin, and we track every single one of them, we pay immense attention to the administrative key of that stablecoin and looking at normal behavior of minting and burning, because a stablecoin admin key hack could be one of the most damaging threats to the industry, because if I can hack a stablecoin and I can go drain an exchange with that on-chain asset, and you can do it really, really quickly. So there's a lot of different risk vectors you can monitor because of the nature of the open and public blockchain. You just have to know what we're looking for.
Thank you. Laurent, from your perspective, before we go to like mitigating risks, what risks do you see from your perspective?
So just to add on what Anoosh said, I think the biggest product we have and the biggest type of risk we are covering is clearly like the custody, so linked to the safekeeping of the assets. We've been working on this by building facilities on the London market, because in Switzerland and most of the countries, the traditional insurance market, they are not ready. They are not. They don't have enough data in order to be able to provide comprehensive coverage. So what we did is we built a facility in London for everything related to specie. So it's a specie coverage. So everything related to cold storage. We also have a broader one, which is called the crime. So it's everything that's linked to theft of asset. So that's the main product and the main risk that our clients wants to mitigate and to transfer to the market, to the insurance market. What we see as well is now the industry is getting more professionalized, and they want also to have coverage for the liability of their directors and officers. So everything related to I don't know, regulation, mismanagement that would cause financial losses. They want to transfer also the risk to the market. And the third one would be the outage and the failure of technology or service provider, including data breach, because companies also have centralized data that can be hacked, and they want to be covered also for ransomware and business interruption linked to an attack or hack. So I would say that these are the main three topics we are covering at Aon.
Thanks a lot.
And if I may
Yes,
as well,
please.
it's quite interesting. So from what we've all described, hopefully you can see that none of these are digital. They're not risks that are specific to digital assets. Digital assets and blockchain are basically used as the means in which these day-to-day risks that we've seen in traditional finance for decades are just enacted. And I think that's the point that we need to also just realize. Sometimes it comes down to boring enterprise risk management, of which we've seen many, many examples of various different events. If you look at, for example, I think it was last week, the DMM exchange in Japan that was just hacked of 300 million worth of Bitcoin. What happened there? Again, everyone speaks about address spoofing or address poisoning as if it's a novel thing, where in fact what's happening there is a fraud or a fraudulent type of attempt preying on humans' tendency to not look at all X number of characters in an address, right? So it's thinking about it that way, right? How can we think about the day-to-day risks? It comes back to process, and how do we manage those through much more automated fashion?
Can I add one more thing to get completely off topic or off the agenda? I think there's a sense sometimes that so far we've been talking about all these negative things and like, oh shit, the compliance guys are gonna like ruin all the fun. I joined this industry because we can do it differently. Like I hated the rules that you can't explain. There's no logic to it. There's all this paperwork. It's like the compliance guy always saying no, and you don't know why. Like we don't need to do that. We can make things better and put these controls in place in a more thoughtful way. And so I think there's a big opportunity here, and I think we should just accept that there is risk, and let's mitigate that in a very different, more effective way together.
Thank you. And well, from a compliance and a risk perspective, I agree that there's so much overlap with the TradFi world in the job description of a compliance officer or chief risk officer. But would you agree that the means on how to mitigate those risks, are they different or are they very similar? Are there any tools that the TradFi world would not have?
Absolutely. Just to piggyback off of what Josh just mentioned, I think we're in an incredible position being in the second line of defense within the crypto space. And I say that because the tools that are at our disposal are, if I may say so, decades ahead of what you see in traditional financial institutions. And I think that is in itself the inherent beauty of the blockchain. Everything is transparent, right? Even in the case where we say pseudonymous, not anonymous, it is still transparent. There is still data that you're able to capture and try to understand the association with that wallet address. I think to your point, we've seen a lot of firms become market leaders now in the sense that they gather data off-chain, on-chain to portray perhaps a financial crime view. So tools like Chainalysis rather, Elliptic, TRM, etc. They've become leaders in that space. You've seen tools like Coinmetrics, for example, perhaps expand in terms of the remit in what it's covering, not just for trading purposes, but actually moving beyond that and using the information in there to make some really valid decisions. What I would like to see, and what I think has super, super potential, is the combined use of AI and blockchain data. And I think you're starting to see a lot of projects or initiatives that are out there that are trying to gather data on various different chains, combine that with off-chain, on-chain, in order to actually paint a picture of a wallet risk score that isn't just looking at sanctions lists and financial crime, but it's actually quite comprehensive. It can tell you the probability that address is linked to, for example, rug pulls, poisoned addresses, etc. Which I think that's where we should all be working. To Josh's point, how can we make this better?
Josh, do you have something to add? I can share the mic. Okay. Tim, how do you see that? Like what is the special things that the digital assets world has in their hands in terms of mitigating risks?
Yeah, well, I'll pile on a bit because, again, the blockchain does present itself as probably the best solution, and I've been doing this for long. I started in the back office and fund accounting and other places, you know, passing paper tickets and moving money through actually paper ledgers. This is a digital ledger recorded in real time with all the transparency that you need. And, you know, the address that was hacked at that exchange will be identified. We'll know exactly where it went after it left that address. And we may not be able to get those funds back because they may end up in the wrong place. But, you know, I think it's really a special technology. And, you know, it just does what it says. And it does it, and it does it, and just keeps doing what it was meant to do. So, you know, from a risk perspective, you know, I'm kind of looking at the conversation here, I think the challenge we had as a business, frankly, is explaining we weren't a crypto business, that we were a data business, that we don't actually trade coin, hold coin, move coin, or whatever else. The name of the company is Coinmetrics. So there's a half an hour explaining to someone that you're not in crypto and you don't hold this. But it just takes some time. And you know, I can tell you how many banking relationships we lost last year, and now we have 5 new ones this year as a regard of SVB, Signature, Republic Bank, all of these other ones going. So just touching it sometimes affects you as a data company. This company is the same as things that I built everywhere else. So I think it's interesting how you get kind of collateral damage when we get some bad actors.
We very much feel the pain of having or opening a bank account as a crypto company in Switzerland. The struggle is real. Even though we have crypto banks here or crypto-friendly banks, the struggle is still the same. How is it with insurance companies? An insurance company should be more open to accept a crypto company because of all our powerful tools, or isn't that not the case?
No. No, definitely not, and that's the problem. That's what we are working on a daily basis. So basically, we could say like AI, blockchain, transparency of the ecosystem, and so on would help the insurance to come with quotes, to understand the business, to propose good coverage, good premiums, and to transfer the risk at a in a more suitable manner. But in the end, it's not the case because most of them, they don't understand. They don't have the knowledge to understand what we do because they see the news. It's also linked a lot by the news, the trends. If the market goes up, it's like they're opening up a little bit. If it goes down, they close everything. They want to cancel policies. They want to withdraw from some accounts. So that's what we are witnessing. So our job as a broker, we want to educate them because what are they missing is more data. They need to have data on the loss because that's how they are building their pricing. So if they first don't understand the ecosystem, they don't have data, they don't want to provide any solutions. So on an insurance perspective, and I totally agree, AI, blockchain, transparency should help, but in the real world, it doesn't. For the moment, it's not.
In percentage, how far are we on the education level of insurance companies?
We have specialized insurer on the London market. It's more really like Lloyd's or Bermuda. We have carriers that are open to crypto market, like on traditional, like Swiss or European, and the traditional insurers, it's quite difficult. I think we are opening up. They are opening up to the new technology because I think they understood that crypto is here to stay and it's not going to disappear overnight. So they will have to deal with it and they will have to tackle the ecosystem and the industry. I think we are like 50%, 60%. But it will take more time, I think, to educate, to do workshop with them. And that's what also we are doing on a daily basis.
If I can so I think one of the challenges that we have to remember is we're all here because we care about crypto, but not that much of the world cares about crypto yet. And so when you look at generating revenues as an insurance carrier or broker or whatever, and it's a tiny little line in your revenue stream, you're doing your best to invest in quality services and care, but until we continue to scale, I mean, NVIDIA and Apple each are both bigger than this industry right now, right? So I have to step back all the time from my Twitter feed and everything else and realize that, oh, I have children, there's a world out there. People care about other things than crypto. And I think this is the problem with a lot of the service providers from the traditional world looking at us like we're a crazy little petri dish. So you have to give them some respect for why you can see they would do that. There's not the financial motivation for them to do this because it won't add up. And to train someone up, which is the same thing with the regulators, right? It's the same thing with the regulators, the insurance companies, anybody who provides it. It's kind of like, we're so small, and we've demonstrated that we're amazing at enhancing risk if we're held within your portfolio, but when we blow up, oh, like, we really blow up. Like, we don't go in the middle yet. We don't do anything halfway, sorry.
Yeah, just to on a more micro aspect of that, and the insurance companies certainly on the larger scale, dealing with asset managers, and this goes back to kind of like, it makes so much sense to add Bitcoin to your 60-40 portfolio, and it's a better portfolio and it performs. That's a compelling story for an investment professional. For a CCO hearing that I want to buy crypto, they're going to say no because it's so small. Because the way to implement that strategy is going to be at a very small percent. It's 1% of your portfolio, maybe 5%, if we're getting crazy. So I think we need to get better at kind of educating at that level as well. So the RIAs in the US or any other multi-strategy asset manager, again, their investment teams can make a compelling case that this should be added, but you're going to hit a hard stop at the compliance and legal level, and getting them comfortable with us and our ecosystem that it's not just going to crash, that it is safe, I think is a big challenge that we all need to work on.
Thank you. There is definitely a risk that we will blow up or something will blow up. What is this residual risk that you see that you really have to accept within your risk management framework, and how big is it? How do you live with it? You want to go, Josh?
I mean, yeah, so Talos is software, and it's kind of a nice place to live. Like Tim and I were talking about, our businesses are not, we don't own assets, we don't trade them ourselves, we're not in the flow of funds. But we deal with very regulated entities, and especially in the US, to onboard with a large custodian or whatever is going to be a big hurdle. I think that what we can all do and what gets compliance people comfortable is disclosure. So we talked about the conflicts of interest disclosure, but there's still not a level of kind of a common playing field of like what is this token doing? What's out there? Is this volume real? Right? And Mika has done I think a decent job with a really intense level of disclosure, and we'll see how that plays out. But I think once we get disclosures that we can all trust and we can kind of compare apples to apples, I think that is how I'm hoping to kind of deal with some of our mitigating factors.
Tim?
Yeah, I think one of the things kind of off of the conflict of interest, so I was fortunate to be running a business at Reuters in 2008 that did the LIBOR fixing settlement rate. And the challenge there was the collusion of the participants within the banks in London on the fixing. There's great books, great coverage on it. Because we're so small, and I was listening to a panel earlier talk about indexes on new things and how we calculate indexes, it's easy to move a market if you get a group of people who are collaborating around some endpoint. So I think for me, the size and the capability of people now with machines and AI and other things to manipulate these markets is an ongoing risk. And as Anoosh said, it's probably a positive thing we can use to catch them or catch up with them. But I just think there's still an opportunity for a fair amount of manipulation. And we put a lot of effort into kind of trying to see through it. But it's still a big thing for me.
Anoosh, how do you see that?
Yeah, I think for me as well, just going back to your point, it goes down to the ironic level of centralization in this decentralized space. The things that the things that make me a little bit worried is just thinking about, okay, what would happen if one of the large centralized exchanges were to fail? Are some of them, quite frankly, too big to fail at this stage? What would happen if some of the largest node providers were to fail? I'm thinking of proof of stake models here, and we've seen an example of that happen as well not too long ago. I think there hasn't been enough coverage or understanding, okay, is there a network of custodians you want to work with? Is there a network of exchanges? Are you monitoring your exposures and your limits on those exchanges, or even software providers at the same time as well? One of the things that I would say that actually Mika is helping out with, and you'll see many firms that have been in traditional finance, they are used to this, things like wind down planning. It's a necessity, I will say, especially for custodians. That's something that your clients need to have that trust that if you're not there tomorrow, how are they going to get their assets back? So yeah, I would say concentration risk.
Thank you. Laurent, is there, from like an insurance perspective, is there an insurance against FTX or Binance failing, or what are the
No, not really. I mean, what we stick to traditional like theft of assets. So this is the main one, and just on this one, I think it's important to know about the residual risk that we tell our clients that we cannot transfer all the risk. We cannot insure all the asset under custody to the insurance market. It's impossible because first we don't have the capacity, and it would be ridiculous in terms of pricing. What we see, and just also to add on the traditional insurance market, we need to train them. We need to give more explanation. It's hard also to find in the industry people that wants to take the time to educate them, and it's also the fact that the industry they don't trust, they don't want to pay that much of premium for insurance, and on the other side you have the insurer who doesn't understand the real risk of the activity. It's not helping. So basically we are quite in a dead end, and that's why we need to continue, I mean, on a daily basis to get the insurer inside the industry, like to explain and find new solutions. Also, we have now product for slashing events. We can also insure the slashing event and the penalties. So we are also trying to innovate in that sense and creating more workshops. So yeah, that's what I would say about insurance market.
What is, just one question, what is the top 3 insurance products that you would see from the crypto industry?
So the one that we are receiving the more request about is directors and officer liability, clearly, because the industry is getting more professionalized, and the TradFi people are now coming at like high level position in the industry, so they want to have the same kind of coverage as they had before. So I would say this. A lot of association also now wants to have DNOs coverage, so directors and officer liability. Second one would be definitely theft of asset for a crime, so on-chain, hot or cold storage, and also data breach and technological failure. So basically, you're offering a platform service, and the platform goes out. You don't perform the service you were supposed to deliver, and then you can get coverage for that. So I would say that would be the 3 main coverages we are offering.
Thank you. Josh, you wanted to add something?
The scenario of the FTX collapse just made me think of something that, so we, at Talos, we just acquired this company, CloudWall, which some of you may have heard of, but what the interesting part was for the portfolio managers in the room, it is these scenario analyses, right? And it's not your general like oil crisis, like the first slide that Tim showed, right? Which is what you see traditional managers do. It was crypto-specific ones, and then how do you hedge that risk? Or how would your portfolio behave in a scenario like that? I think it's certainly an evolving field, but I think for portfolio managers, I think those sorts of tools really give you a chance to kind of get ahead of any sort of collapse.
Thank you.
And
Yes?
just on the point that Laurent mentioned about the educational piece to the insurers, I think the other thing that we don't particularly do well as an industry is the use of specific terminology. Sometimes we say we have a catch-all term, like even the term crypto, that means everything and nothing, right? If you look at each of the thousands of coins that's out there, they all have significantly different properties, even if they are using the same consensus mechanism. Sometimes we're not specific enough, whether it's the terminology crypto, whether it's even the word staking. There's hundreds of different staking models out there, even if it's just looking at the same chain. One of the things that we really need to work better on is just making sure that we're understanding each other, because I think at the end of the day, that will lead to things like premium relief, that will lead to understanding what your risk actually is.
And also, I totally agree. I mean, if the guy I'm talking to doesn't understand what I say, it's not possible for him to sell it at his board level. So in the end, I can talk to a guy who will say, okay, I like the idea, I will offer coverage, I want to develop a product, an insurance product. But if he doesn't understand, if he understands it but cannot explain it to his boss, I mean, it's also a dead end. So definitely the terminology is super important, and to try to simplify at maximum what the industry does, it's key. I think it's necessary for the traditional insurance industry.
Don't even get me started on the word tokenization. Again, it means everything and nothing at the same time.
Tim, you already mentioned the outlook briefly. How would you define your personal view for the next few years? What would be like your wish list towards the regulator? DARA, you called it. What else is on your wish list for the future?
So I have this weird saying that people come to crypto to change the world until it changes their world. And it does change your world if you're around long enough, because you become wealthier than you ever expected to be. But all of the pattern matching for businesses that I think are successful are long-term businesses. They're not a 3 to 5 year business. They're a longer-term business with a longer-term plan on how to survive. And so I'm hoping that we can, within the industry, create career paths and career opportunities to bring younger people in, to get older people involved and mentor these people into this category and, you know, kind of do it correctly. So, you know, I think from where I've been doing this for 5 years. I've run into more individuals who are on their 5th, 6th, 7th company in this space. In the 5 years, I'm kind of like, there must be something wrong with me. I need to move on. But honestly, it really is about longevity in the space and time. It's like anything else. The amount of time and practice you put into doing this and bringing younger people into this area and teaching them and working with them to understand that this is, the yield in this space is so incredible, like I said in the beginning, and they don't understand what a 3.5% treasury yield can just do over 40 years. They want 80, 90, whatever we've got this year. And I love it too, so don't get me wrong, but you know, and I'm the old guy in the room, obviously, right? So I'm just kind of sitting here reflecting on the companies that I've worked for, built before, sold or went public after overnight successes of 17 and 20 years. And I don't think we have folks yet in this industry who have the grit to kind of stay at it. So for me, it's kind of like getting the culture right, getting people here to stay, and convincing them this is a really special industry to be in.
Anoosh, what's on your wish list?
What's on my wish list? I think I will go back and say better collaboration across the industry. I think we are seeing it is getting much better, but trying to understand, I can't remember who we were speaking with this about yesterday, but it's not, we need to work together, right? There is a network, the pie is big enough to fit in the participants. We need to work together with a network of custodians, a network of exchanges, software providers, and really to maximize that partnership angle, both with on-chain information and on-chain partners, and then separately off-chain as well, because I think in those points of transposing on-chain to off-chain, or when a transaction occurs, I think that's when we really need to be quite careful and mindful that breaks do happen.
Thank you. Laurent?
I think my wish list would be more partnership between the industry and the guys I'm working with in London, definitely. I think also more clarity on regulation about what is needed in terms of coverage. because it will, if you look at the MiCA regulation, there's a whole article, whole clause about insurance, but honestly it's super vague, so it doesn't bring clarity for clients basically to know what they need to be, when they need to purchase and in order to be compliant. So definitely I would say regulation and partnership with the ecosystem.
I agree. Josh, what's on your list?
I would say the SRO. I mean, that's one of the first things that I really kind of got passionate about was trying to find the groups that were trying to start those. And to Tim's point on the consistency, one of them, I don't know where they went. Like they were big and expensive, and then they wouldn't answer the phone. But at one point, I think they were one of the larger groups, and then they're all kind of like dwindling away. And sometimes it's because leadership leaves, right? It might be a really driven organization from one person who's getting all these people into a room, and then they move somewhere else. So it's very hard to maintain momentum when you have that kind of turnover. So I definitely an SRO, I think, would be an amazing thing for the industry if we can all gather around one.
Fantastic. I think it's time to grab lunch, unless there are questions from the audience. Yes, please.
Why should people hold their tokens on centralized exchanges when they can hold them on non-custodial wallets and not carry the risk if a centralized exchange goes down? If they hold it in non-custodial wallets, they still have their tokens.
I'll let Anoosh answer that, but I don't hold anything on a centralized exchange.
Yeah, I think it boils down to your risk appetite, right? So for retail users, for individual users, as you look at things that might fit into your risk profile to keep your own keys, right, and to have a non-custodial wallet. For larger institutions, with upcoming regulation, given the level of scrutiny that they're under, the audits that they require, self-custody typically isn't an option. So that's where you appoint an expert custodian, for example, to do that. It helps as well with off-venue or off-exchange settlement, reduces that counterparty exposure. But again, different risk appetites, big institutions versus retail.
Laurent, can I insure my ledger stick that I have under my pillow at home? Sorry. My ledger cold wallet, can I insure it?
Under his pillow.
No. No? All right. Any other questions from the audience? Yes, please, here.
So with the advent of ETFs, is that related to risk at all, or is it just allowing the masses to play in the digital world? Like, is there a message in terms of risk, or not at all?
I'll state an opinion. You now probably have, given the 13F filings are out on who has bought these ETFs, you can start to look at the persona of those corporations and endowments and realize you probably have a floor in for where the price of Bitcoin would be. We have a consolidation issue risk when it comes to vendors supplying services to the current ETFs. BlackRock set the tone, said these are the providers that'll be allowed to engage with this ETF. Everybody else followed suit. There was, the CME was here earlier. They are the benchmark provider behind 6 of or 9 of some of these things. Coinbase is a single point of failure as the custodian of the physical asset behind all of these, which is why we need SAB 121 repealed. So Bank of New York, Zodia, others can get into this space. So, and then now we have an Ethereum fund in the US that's probably approved. The point of what I was saying earlier is they're throwing stuff at us that is going to create risk. So now in the wealth management and advisory space, everybody's gone to market for the past 6 months and said, here, do a 1% or 3% allocation to this Bitcoin fund. And now along comes an Ether fund. What am I going to do? I'm going to put my clients into a capital gain situation to move them into crypto some other ways. So I worry we're being given stuff without the government in the United States giving regulation. So that's what I see as the risk of the ETFs.
That's actually reminded me of another item on the wish list, which is practical regulation. Not just regulation for the sake of it, but practical, working together across industry to make that happen.
That's on my wish list as well. Any other questions? Let's have a last one. Well, we're good. So thank you, everybody. Thank you to my speakers. Enjoy your lunch.